Hi, this is Paul Larson with Larson Capital. I've got Jon White with me, and I'm pleased to have him here to talk a little bit about some of the things that are going on with Larson Capital Fund 4. We had a pretty eventful year last year, and we're excited to kind of give you an overview of 2018 as a whole. And then also we're going to talk a little bit about 2019 so you have an expectation as to what distributions we're looking at having come out. And then also some of the other details that we'll talk about with K1. So with that, I think it'd be good to just maybe reflect back for a moment just on the structure of this particular fund. Obviously, this is our fourth fund, but what we did differently with this fund from previous funds is we really tried to diversify outside of the core real estate that we traditionally do within Larson Capital. And we were looking for investments that had an opportunistic opportunity for us to really see an increase in value over a shorter amount of time. The hold period of this particular fund is still set to be about the 5 to 7 year time period. But what we were looking for is a way to buy things that maybe had a little bit more risk, but had a lot of upside. And so I think what you're going to see in this report is exactly that. And so for starters, going backwards, when we launched this fund back in 2016, we were able to pretty quickly get into some cash distributions as far as getting this property and this portfolio of buildings purchased, more than we anticipated. You can kind of see that in the 2017 cash returns. We weren't really expecting to have large cash distributions on this particular fund because of the nature of the types of investments in here. Just to refresh your memory for just a moment, we had a purchase of a Woods Mill Point, which was a building that's in Chesterfield, and that's an asset that is just outside the main St. Louis metro area. And I think the fund owns right around 30% of this particular investment. And so we were able to renew a lease there, which was a big plus for us. It's a group called the Burns McDonald that's in that building, and we extended their lease. I think, John, was it like a 5 or 6 year period? What was the term that we were able to extend there?
Just over 6 years.
So when that happens, it immediately drives up the value of your building because the value is going to be its highest when you renew those leases. And so that was one thing that we focused in on with our investment inside of LCF4. The other investment that was a little bit more interesting for us was to invest into 3 separate projects. One was a high-rise of student housing, and it's in Champaign, Illinois. And for those of you who have been there, there's not a lot going on in Champaign, but there is a huge school there, and they had a massive shortage of student housing. And so we went ahead and invested some money in that particular area and had it built. And I think there were about 200 rooms, and effectively all of those got leased out. And it was such a success for us that the decision was made to go ahead and sell that. And so we put in about $750,000 in this grouping of 3 different investments. And just this last year, we received that approximate $700,000 right back out, which in essence paid back all of our deposit for that entire investment as a whole. The other 2 investments that happened inside of that particular fund, one was a it's called the Cottages, and it's this idea of having a shared living facility with 8 rooms and then a shared kitchen. And so as folks get a little bit older, they need to have some help. They like to live in kind of these communities. And so we actually own the real estate, and then we also own the actual underlying business that operates that assisted living. And then the final project is just now being wrapped up last year with an assisted living facility, and that was in partnership with SSM Hospital, which is a local, pretty large health system that we've got some great contacts with. So that's high level where we're at. The last building that's inside of LCF4 is a building that we call the Nines, and this is a Class B office space. And so I'll maybe have John just kind of add a little bit of color to these different investments and give you some feedback as to what to expect as we head into this next year, and then maybe just kind of give you a summary of how things performed on the expectation. And so maybe I'll go ahead, John, and maybe just give your perspective as you've been working with the team to manage these properties.
Absolutely. So starting with the Nines building, coming into this year, I should say when before the property was acquired, one of the biggest risks in this particular asset was the bottom floor. We had a larger tenant, kind of an awkward style space. We were not quite sure whether their business would renew. We found out earlier this year that they would not be renewing. So we quickly worked to backfill the space, and I've got the lease sitting on my desk right now to go through with the Parkway School District, which is a large school district here in St. Louis, is going to backfill approximately 11 to 12,000 square feet. So what you'll see from a cash flow perspective is a lot of the money for the Nines for free cash flow is going back to pay for this particular deal. As far as Woods Mill Point, I think Paul alluded to this. It's 100% occupied. Building performing exactly as we underwrote it, and continues to perform very well. And Paul's already touched upon our other outside investment.
So I think that's a good overview. And just as far as the cash is concerned, the first 2 years of ownership, we've paid out in the first, partial year of ownership is about a 1% distribution. If you include the depreciation in there. So there's no cash paid back in the first year. And then the second year, if you're just looking at pure cash, it was a 7.73% distribution. And so again, that's a little bit more than we expected with this particular investment and fund, just because of the type of things we're buying. For 2018, what we had shared with you was this expectation. It was to be somewhere around 12.33%. As a distribution in this calendar year that we just finished up. The reason why we did not hit that mark is because we made the decision as a group to go ahead and use a big chunk of the funds that came in from the sale of that student housing facility that finished and closed a little bit earlier than we were expecting to reinvest into another property that I'll show you in just a minute. But as far as the cash distribution that you received through the course of 2018, you were at 6%. And so there won't be a fourth quarter distribution because of this next thing that I'll share with you, but we effectively took $600,000 and we rolled it into another project. So these are just the traditional disclosures that we have on all of our funds, and anytime we're sending these videos out, just to remind you that these funds aren't guaranteeing any returns or anything of that nature. But what we do try to do on an ongoing basis is to kind of open things up and let you see exactly what a budget looks like. So what this particular screenshot is showing you is the 4 different projects that we have within this fund. We have $2.9 million of investor cash that came in. And the Nines building is what John just alluded to. We're going to spend some money in 2019, about $350,000 to secure that Parkway School District building and getting that lease built out. And so that's going to be a big expense for us. And so we've been budgeting for that and planning for that. So we've got cash. We don't need to worry about any capital calls. And you'll also notice that we have a big chunk of cash that's going to pay down debt. So $166,000 is going to pay down our loan, which is great as we look to this budget. And so Iron Rock is the investment that we made to buy those 3 different projects. And when we spun out that $600,000 of profit, what we decided to do as a group, given the fact that we still have about 3 years left on this particular fund, is to go ahead and redeploy that back into another real estate property. So we're really excited about this particular investment that came across our path, and we actually just closed on it about a week and a half ago. So John, do you want to kind of share a little bit of the backstory on this particular building and kind of how you see things laying out as we own this for the next 3 to 5 years?
Absolutely. So this building is in the West County, St. Louis, a very hot submarket. What we identified early and what we really liked about the asset is it was substantially under market in terms of rental rates. The last deal I think that was done in this building, mid to upper 20s. Some of the buildings surrounding it are actually getting higher than that. Most of the leases in place in this building are in the low 20s. So from that perspective, there's a lot of upside potential. It's also a very stable asset, mid 90s occupancy. in a market with 4 to 5% market vacancy. So it's very, very stable, with a lot of runway to improve value.
So I think what John had shared with you is the budget that we have for this next year. But I will tell you that that particular investment is not factored into this budget. So we are expecting to have some distributions in 2019 that would be coming from that particular building. But a lot of this is going to be a function of what the other investments inside of this Iron Rock investment do for us. So right now, I would anticipate not having significant distributions in 2019 for this fund as we get the Nines building really set up and teed off for a nice runway of rent coming in. But it is possible that we'll have some distributions through the course of the year. So just to speak about some of the other mechanics for this coming year, we've got K1s that'll be showing up for you by March 31st. So those are going to be in your inbox, and you can get your tax return processed by April 15th that way. The other thing that you should know is that we have a portal that will be opening up here soon so that you can see all of your real estate investments really in one place. And so our aim there is to give you an idea of what your total cash deposit has been, how much cash has come back to you already in distributions. And then ultimately, when we sell the buildings, it'll show the final amount of money that you have earned in your account. And so if you're interested in continuing to diversify inside of real estate, we do have a fund open in the next week or two. It'll be available. It's called LCF 6. And this is going to be a pretty large core real estate fund. So we're looking for real estate in this particular fund that's going to have about an 8 to 10% annual cash distribution. And we're looking for large tax deductions using the cost segregation and the depreciation that we've done here, even with LCF 4. And then also, it's going to be looking for things that have a nice increase in returns. And so if that's of interest to you, let us know. We also have a lending fund that will be opening up, and that's going to be a debt fund. So we're raising investor cash with the idea that we're going to lend money out the door, and it's going to have about an 8 to 10% rate of return is what we're anticipating, and it'll be a shorter duration of 3 to 5 years. So again, if you have any questions, you know where to find us. We've enjoyed working with you, and as always, have a great day, and we'll be in touch.